Hello, I'm Adrian Finnegan. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and finance. This week, gold. What's it really worth? Out of favour for now, but could gold be on target to hit $10,000 an ounce? Well, we'll talk to the man who believes that to be the case. Also this week, we're on Iran's Kish Island, an economic and tourism mecca. We found out why free trade zones are becoming booming business in the Middle East. And not in my backyard, as Thailand builds for the sky, we meet the residents who don't want expansion at any cost. Gold's taken a battering of late, no longer seen as a store of value, as the US Federal Reserve indicates that it may slow the pace at which it's buying debt. Now, buying debt has helped to underpin the flagging recovery, a recovery that's taking shape as the financial system appears to be stabilizing. And China's deliberate attempts to slow its economy for the right kind of growth has taken the shine off commodity prices. So it may surprise many that someone thinks there's potential for a gold price 10 times its current level. We'll get to him in a moment. But first, we have to address the decline. From a record high of $1,921.15 an ounce in September 2011 to a 34-month low of $1,180.50 on June 28th this year. And according to predictions from Danske Bank, the price could drop further to $1,000 in just the next 3 months. Now that can really mess up your portfolio if you're not careful. This is John Paulson, not known much outside investment circles, but he's a guy who made $15 billion in 2007 betting against subprime mortgages. Now, he started to invest in gold as a hedge against currency debasement and inflation. In other words, efforts from central banks to flood the markets with money. He made losses, the exact amount unknown, but his gold fund is said to have fallen by half. But as gold miners slow production with the cost of producing an ounce close to $1,200, there is a belief that gold prices could in fact rise as demand grows in Asia for the wedding season and religious festivals. But $10,000 gold? Well, maybe. Nick Barisheff thinks it's possible in the next 5 to 10 years. His gold bullion group has almost $500 million under management, and he's even written a book called $10,000 Gold, which outlines his argument. Nick's the CEO of Bullion Management Group, and I'm pleased to say that he joins us now from Toronto. Nick, welcome to Counting the Cost. A couple of things I want to talk to you here about the recent fall in the price of gold. The first is that people are obviously more confident in the dollar and believe the dollar remains the international default reserve currency. And two, people are asking themselves, well, why hold gold? There are no returns. I'm not holding any interest. I'm not earning any interest here.
I get asked this question very often, and the simple thing is most people that really understand gold do not want to take it out of the vault, give it to somebody else in return for any dividends or interest they may get. The same thing would apply if you held physical dollars, euros, pounds, whatever in a vault. You would get no interest or dividend. You only get interest or dividends once you put your wealth at risk and you risk not getting it back.
All right. Most commodity analysts believe that gold prices are going to rise in the second half of this year. You're confident, though, of a new high before the end of the year.
Well, that's right, because there's a lot of confusion in terms of is gold a commodity or is it a monetary asset, and that's the starting point of understanding. Gold, silver, and platinum have been money for over 3,000 years. And if you look at the financial statements of the major Western governments under the balance sheet, you will see monetary assets as a subcategory. And under that subcategory, you would see only two items: foreign currency reserves and gold. And there hasn't been a single fiat currency throughout all of history. There's not one example that didn't end up in a hyperinflation and complete collapse. Today, we've got a different set of circumstances in that we've got a global fiat currency system, and it's starting to become exponential in terms of the amount of currency in circulation and the amount of new currency as it's created. And this ratio has always been intact. There's almost a perfect correlation for example, between total U.S. debt and the gold price.
Let's get to your idea that gold's going to hit $10,000 an ounce. Why do you think that is? Most commodity analysts you speak to, they'd say inflation-adjusted gold is worth around $720 an ounce right now, and that they believe it's still got some way to fall.
As you mentioned in your introduction, it can't fall below mine production, which is at about 1,200. If it falls below that, mines shut down, no new exploration is done, and then demand totally overwhelms supply, and you get a price increase. So for that reason alone, it's not a valid explanation. As the price rises, certain commodity demand, like pure jewelry, may drop in demand, but monetary demand goes up right now. And for example, on the Shanghai and the new Shanghai Gold Exchange, which is a futures exchange, the amount of gold deliveries per month are almost equivalent to total global mine supply. So it's the monetary aspect that's overwhelming, and it's not the commodity aspect that makes the difference. From a point of view of inflation, the accurate way to look at it is the wealth preservation aspects of gold. So if we looked at how many ounces of gold it took to buy a car in 1971, when it was depegged from the US dollar, was 66 ounces. Today it's 10. A house was 703 ounces. Today it's 228. The Dow was 25 ounces. Today it's 8. The only thing that's held its value is oil. You would get 12 barrels of oil for 1 ounce of gold in 1971. You get 12 barrels of oil today, even though the price has gone from 20 to 107. So that's the true measure of the wealth-preserving aspects of gold. It doesn't get into adjusted statistics in inflation and money supply and all the rest of it. It takes all that out.
Does the world need currencies linked to commodities to avoid debasement? Is it feasible even with a growing population? Everyone worries about fiat money, you mentioned earlier.
Well, it is. We haven't, as humans, come up with the perfect system of money, but for example, in all religions, there's consistency that gold and silver are the only forms of honest money. And if you go back into the U.S. Constitution, it says the same thing. It had its flaws, but right now the problem is we have the ability of the central banks and indirectly the governments to print unlimited quantities of money and currency. And when we have that situation, they inevitably overprint, and once you get onto the exponential curve, then you get into hyperinflation. It always happened this way in the past, and I think this is where we're going in the future.
All right, so I've read the book. I've been convinced by your argument here today. How do I go about buying and holding gold?
Well, there's a wide range. Obviously, it depends on the level of your wealth. If you're not very wealthy, you might start by buying silver bullion coins like the U.S. Eagle or Maple Leaf. But as you go up, you need to find a credible storage facility, because it would be unsafe to store any sizable amounts in your home. It's uninsured. You run the risk, and then it needs to be reassayed to bring it back. So then you're getting into credible vault storage. For the ultra-rich, they need to diversify into gold, silver, and platinum and hold it in multiple locations and multiple vaults, for really safety. So it's a wide range of where that enters in.
Nick Barisheff, CEO of Bullion Management Group, thanks for your time. Apologies for the technical problems on our satellite link there. Still to come on this week's Counting the Cost, we're on the island of Kish in the Straits of Hormuz as we ask why free trade zones are so popular in the Middle East. More than 3,000 Filipino workers in Taiwan are being fired every month as diplomatic tension between the two nations sour. The Philippines and Taiwan are vying for territory in the South China Sea. In May, a Taiwanese fisherman was killed by the Philippines Coast Guard, complicating matters further. Jamala Alindogan has more now from Manila.
It's been almost 2 months since Maridel Gatarian returned from Taiwan. Working in a factory for 2 years, she says she was happy because her earnings helped support her family back home. But now she's unsure if she'll ever be able to go back, and that uncertainty has made her very anxious.
What can we do? We are here now. It's very difficult to find a job here in the Philippines, and the salaries are not enough compared to what we earn there. With my job in Taiwan, I was able to help my family.
She, along with other overseas Filipino workers, are hoping to hear news about their deployment back to Taiwan. But its government there is refusing to accept Filipino workers. The hiring freeze in Taiwan started after one of its fishermen was killed in May, suspected of poaching in disputed waters in northern Philippines. Taiwan and the Philippines conducted parallel investigations. But the Taiwanese government says the delay by President Benigno Aquino's administration to release its report has stalled efforts to resolve the issue. As many as 16,000 overseas Filipino workers have already been affected by the diplomatic dispute. But the Philippine government says it is not worried, claiming there are enough jobs in the Philippines for those who have returned. But many say the Philippine economy's dependence on foreign remittances has made it difficult for Aquino's government to negotiate with countries it has conflicts with.
Of course, I am hoping that the indignation has already simmered down after a while. Time has a way of healing hurt, and hunger and anger.
There are almost 90,000 Filipino workers in Taiwan, and more than 10,000 of them are set to lose their jobs by the end of this month. And like Maridel, all they ever want is job security and a chance to provide a better life for their families. Instead, they find themselves caught up in a conflict that has little to do with them. Jamela Alindogan, Al Jazeera, Manila.
Thailand's capital is undergoing a construction boom with malls, hotels and apartments being built right across the city. Next on the list for development is a large piece of greenery in central Bangkok, where the owners want to build more of the same. But as Wayne Hay reports now, some people are saying enough is enough.
While other economies grind to a halt, Thailand's is moving along nicely. As a result, the fast-paced, congested capital city is coming under increasing pressure. Bangkok is experiencing a construction boom. Vacant land is being turned into yet more high-rise hotels, apartments and sprawling malls. Some believe that for the sake of the people, it's time to stop.
Right now we are raising our kids in the department store more than in the library, more than in the park.
Next in the development pipeline is the largest green space in the heart of the city, more than 100 hectares. It's a partially used railway yard that's become an overgrown train cemetery. It certainly wasn't by design, but the mere fact that a large part of this land has been abandoned for so long means that it's already an important green area for Bangkok. It's owned by the State Railway of Thailand, which wants to lease it to property developers. Opponents want the area turned into a museum and public park and have started an online campaign. But it's also about changing the mindset of residents who have simply accepted Bangkok's concrete expansion without questioning what's best for the city.
Look at Bangkok in 50 years from now, and I want everyone to think about what kind of life or what kind of city you want Bangkok to be. And can we start doing it now?
The law says that 30% of developments must be green, but like many laws in Thailand, there are loopholes and a lack of enforcement. The government and railway officials wouldn't give us an interview, but one of the men responsible for drafting laws and advising the government is backing the call to save the area.
The development in Thailand for the past 30 years is it's not sustainable. We have to live in sustainable environment.
At the very least, opponents want public consultations to take place before any decisions are made. That's a largely foreign concept to big business and government in Thailand. Wayne Hay, Al Jazeera, Bangkok.
In the midst of a crippled economy and tough international sanctions, Iran's Kish Island offers an easier way for businesses to get goods into Iran. There's no tax either. The Iranian government promotes Kish as a business hub for the Middle East, but also as a tourist attraction. Our correspondent Soraya Lenny was given permission by Tehran to travel to the island.
This is Kish Island, Iran's own slice of tropical paradise, right here in the middle of the Persian Gulf. It's gone from a place of just villages to a small metropolis in about 20-25 years. And one of the reasons is because Kish is a free trade zone. That means there's no tax on imports of raw goods, no customs on exports either. You don't need visas to get here if you're a foreign national. There are financial incentives for foreign businesses too. And it uses the UAE free zone and that relationship to move goods into Europe and into the United States. That's something that's become increasingly difficult because of sanctions on Iran's central bank and other industries. Now, Iran's original plan for Kish is something like Doha in Qatar, a place where foreign businesses can set up, can operate with tax breaks, a place of scientific, industrial and educational development. But there is a big difference between the two cities, including a big difference between the UAE as well. Kish still lacks the major investment projects seen in Doha. What's happened is the city has inadvertently moved towards tourism. It attracts mostly Iranians from the mainland, not just for the beach, but for shopping, because goods are supposed to be cheaper here because of the tax breaks. But even the Iranians face problems getting things back to the mainland, where you do have to pay tax on imports. For example, if someone wants to buy a foreign-made car here in Kish, it's much cheaper than on the mainland. Here, they only have to pay about 20% of the value. That's compared to more than 100% in Tehran or Isfahan or any of the major cities. And that's one of the reasons Iran wants to capitalize on what's going on here in Kish, this free trade zone. The imports and the exports, they say there are massive business opportunities here, particularly for importers, not just of cars, but of electronics and clothes and other things. But the problems Iranians face, particularly with buying cars here in Kish, even though they are so much cheaper, is that they can't take them to the mainland for more than 5 years. So for many Iranians, there's just no use in doing this. So even though the idea is here for this free trade zone, imports and exports, it seems like Iran hasn't quite capitalized on what Kish has to offer just yet. Soraya Lenny, Al Jazeera, Kish Island.
Well, just like Kish in Iran, free trade zones are seen as a way for nations in the Middle East to lessen their dependence on oil and gas. It's hoped that international businesses will consider moving to these tax-free, lightly regulated zones, creating high-quality employment in the process. The Arab League is committed to the zones in the absence of a customs union, which has some way to go before being implemented. Now, it may surprise you to learn that trade between Arab nations is somewhat limited, currently standing at 11%. That's not much when you consider European Union and North American trade is running at more than 65%. The United Arab Emirates has 38 free trade zones with more than 15,000 companies. In 2010, investments through the free trade zones reached $73 billion. Dubai's free trade zones account for more than a third of its non-oil trade. Now, I'm delighted to say that Peter Fort, the new CEO of Ras Al Khaimah Free Trade Zone, is joining me now from another free trade zone, Dubai Media City. Peter, welcome. Where is Ras Al Khaimah? It's about an hour outside Dubai, is that right?
Absolutely. That's a very good question. It's about 1 hour's drive outside of Dubai, a little bit less if you're coming from the airport, a little bit more if you're coming to a place like the Media City.
All right, so the
this
question
morning
is...
it took me about an hour and 5 minutes.
Yeah, the question, Peter, is how then do you compete with the likes of the other free trade zones within Dubai?
Yes, that's a very good question. We've been quite successful thus far. We have about 7,000 companies registered with us. They're active, and year to date, the number of new registrations is up about 65% over the same period last year. So we have quite a good formula, and it's a simple one. First of all, we have the same ready-made facilities for foreign investors that many of the other free zones have in terms of offices, in terms of warehouses, industrial land, spread across 4 distinct free zone parks, 2 industrial parks, 1 office park, and 1 academy zone. So we offer the same advantages, in terms of 100% tax-free regime, flexible labor laws, business-friendly regulation, etc. The 2 key ingredients that differentiate us are, number 1, cost competitiveness. And what I mean by that is our prices that we charge to our clients are lower than most of the other free zones, number one. Number two, the cost of living in Ras Al Khaimah is very substantially lower than it is in many of the other Emirates. And so as a result, especially in today's environment when many companies are getting squeezed by escalating costs and are unable to pass those costs on to their customers, they're looking for lower cost alternatives, and we very much offer that.
Peter, I'm just wondering how you prevent the use of these zones, given all of the tax-free advantages that they offer, how you prevent illicit trade.
Well, we have very strict regulations and compliance procedures, of course. Very strict security, and we coordinate and cooperate with all Emirate and UAE federal level government departments to ensure that all appropriate laws and regulations are fully enforced. And actually that extends beyond just the basic requirement of preventing illicit trade, all the way through environmental regulations, safety regulations, labor regulations, etc. So we really take that part of our job seriously, and we ensure that all companies that operate within the free zone adhere to all relevant laws and regulations.
Yeah, the reason I ask that, of course, is because Ras Al Khaimah is just across from Iran on the Straits of Hormuz, and the UAE's been under a lot of pressure to tighten up oversight on trade with Iran, hasn't it?
Yes, and of course, I think everyone realizes that the UAE is being very closely monitored, given the proximity to Iran, as the country as a whole. Again, this is something that we take very, very seriously, and we take all required steps to ensure that we are complying with all international sanctions as well.
Let's talk about inter-Arab trade then. It may surprise many people watching to learn that trade between Arab nations is only just entering double digits. How can these zones help expand inter-Arab trade?
Absolutely. I think there is tremendous opportunity in this area for one very simple reason. As a result of the unfortunate events of the last few years, the UAE has really become the Switzerland of the Middle East, if you will. And as a result, a number of companies, everyone from manufacturers to service to distribution, are basing themselves in the UAE for the purpose of taking advantage of the still high pockets of growth around the Middle East. And really not just the Middle East. I think it's an ideal launching point for foreign companies to address the growing markets of Africa, for instance, given the geographic proximity and the air and other logistical connections, as well as South Asia.
Looking at the cranes behind you there, Peter, give us a snapshot, if you like, in your opinion, where the UAE economy is right now after the financial crisis. It appears that some of the old swagger is back, particularly in the construction industry.
Absolutely. No, without a doubt. If you look at the GDP statistics alone, UAE, I believe, is forecast to grow about 4% this year. Ras Al Khaimah has actually been growing at 8% GDP in 2011 and 2012, and we expect that growth to continue this year. So the growth has been tremendous, and I think the recovery is certainly full force. And the good news is that it's supported from many different angles. Whether you look at logistics, whether you look at tourism, whether you look at industry, whether you look at real estate. It looks like that the economic engine is once again firing on all cylinders.
Peter, it's been great to talk to you. Many thanks indeed for being with us on Counting the Cost. And that's our show for this week. But there's more for you online at aljazeera.com/business. The latest business headlines, plus all of our previous episodes for you to catch up on. And to get in touch, you can tweet either me at @afinnegan, or you could drop us an email, countingthecost@aljazeera.net, our address. But that's it for this edition of Counting the Cost. I'm Adrian Finnegan. From the whole team, thanks for joining us. The news is next on Al Jazeera.